Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Hello everybody, welcome back to another one of our lives. This is the Show Me the Money live show, and obviously you'll see it on the podcast on all the available platforms. Today we are delighted to be joined by Shrena Patel of Octane Capital, but just as a bit of a reminder for those of you who've not joined us before, for those of you who've not heard or followed this before, I'm Sharma. I'm a London-based property investor and developer, and my co-host...
It's me, Marc from Wolf Financial. We are property finance brokers in the specialist area, looking at refurb, bridges, development, trading business as well, portfolios, that type of stuff. And Shrena and I have never worked together, have we? But our paths have crossed over many years. So welcome to the podcast.
Thank you for having me this afternoon. So yes, I'm Shrena Patel. I'm a Senior Business Development Manager for Octane Capital. Octane Capital provide bridging finance, short-term funding for developers, investors, and do everything from auction purchase bridging all the way to your kind of refurb kind of projects in terms of PD conversions, HMOs, and we also help developers doing development finance as well. So we have started up in the ground up space too. So that's a little bit about Octane.
Brilliant. How long have you been doing the ground up stuff? Because that's a new one for me, for Octane.
To be fair, it's only been probably since about February, March, but we have been very selective. We haven't actually completed on a ground up development. It is very niche parameters that we kind of can't go out of in terms of our criteria. So it's kind of for your very experienced borrowers, very good NAVs behind them, and then a certain kind of debt quantum. So we won't do more than 5 to 6 million in terms of a gross facility for a developer. But yeah, we are inviting kind of, your experienced developers into that space in terms of if they have like a 20 unit kind of scheme, 20 flats, 10 houses, we will look at something like that.
Brilliant. Very useful to hear. And tell us a little bit about your background, Shrena. How long have you been at Octane for, and what were you doing beforehand?
So Octane, I will be 5 years in March. So I did join probably a week before lockdown in 2020. So it was great timing. But prior to that, I was at Shawbrook for 2 years, hence where I met Marc first of all. I took over his role as a BDM when he left. And then before that, I did 10 years at Santander corporate banking. So I was doing a little bit different kind of role in terms of it was more trading business, lending on EBITDA, kind of cash flow aspect rather than property. So kind of gone from high street bank, challenger bank to now a lender. So kind of seeing all walks of life in terms of the kind of criteria is available across, those three platforms.
Brilliant. Plethora of experience. That's really interesting. Great to have you on.
So with Octane Capital, the whole market in the bridging space, there's a lot of bridges. What makes Octane special, and why should our listeners maybe choose Octane as their preferred lending partner?
Yep, get asked this every day. So in terms of when it comes to bridging, as you rightly said, there's probably about 105 lenders also that are doing the same kind of stuff. So there's no kind of real USP when it comes to your standard bridging, like your auction purchasing. What I would say, where we kind of excel and where our USP is when we do kind of refurb products. So if any part of your project requires a little bit of light refurb, could be heavy, could be medium, could be something with planning, without planning, that's where we kind of excel. Because what we're able to do is we're able to give you the monies towards the purchase, and it's net 75% day one, let's say, because we roll interest rather than retain. And then on top of that, you get a double bubble because we'll fund you 100% of the works too. We do pay in arrears, but you will get the full kind of work cost as well. And the thing about us is we price on GDV. So in terms of rather than penalising a lot of clients in terms of the day one leverage on pricing, we do it on the back end. So if you're at a sub 65% leverage, your pricing is also much cheaper. We don't have exit fees. We are very commercial in kind of our thinking. So if there is a planning play needed before we can go on a refurb, we will do both options. So you will see what it will look like if you do a planning purchase bridge and then you have to flip it over onto a refurb, basically. So we don't want to leave the developer, the investor, kind of in the lurch. We want them to know the whole kind of scenario, cradle to grave, we can assist, basically. And then on top of that, we have a really good credit team, which you have direct access to. So therefore, you know, the experience, especially in these kind of, you know, refurbs, HMOs, PD schemes. So there's always open dialogues. They're not sitting in an ivory tower somewhere where you can't access them. So we kind of try to be transparent in all our kind of dealings with our clients, basically. So that's kind of why I would say a lot of people come to us because of the rolled rather than retained interest, the good 75% net, and also the fact that we can be commercial in terms of if there's planning, if there isn't planning, what can we actually do in the cradle to grave kind of scenario, basically.
And
I've got personal.
Oh,
No, I was just going to say, just to reinforce what Shrena's saying, I've worked with Octane Capital as a borrower as well, and that was exactly my experience, and I've really enjoyed having that direct access.
Yeah, no, it's good. It's good. So you hear it from the actual end, you know, user that if it's working for an investor as well as a broker, then we can be flexible. So yeah.
And the rolled interest is the thing that I think does set you apart from a lot of your competitors. There's not many in the industry that do rolled interest up to 75%, and it does set you apart because it's all. Most of the customers that I deal with are always looking for the extra borrowing, and that extra 5%, which actually turns out to be 10% a lot of the time, because a lot of your competitors are doing 70% of the purchase price minus the interest, so that takes another 5% off. So it's actually a 10% increase in the money you're going to get on day one, which is good.
Of course. I think there is that kind of retain versus rolled argument that you kind of get into quite a lot, where if you're not quite sure what retain versus rolled is, you could probably go down that route, being if you look at something like for like, it may look the same, but it's actually, you know, a little bit different. So in terms of retain, you're paying day one for all that interest for, let's say, a 12-month period. Well, retain, you're rolling daily, so therefore you only pay up to the day that you redeem your facility. So it's always kind of important when you're looking at terms, is it a rolled facility or is it a retain, because it'll kind of dictate, you know, how much interest you're actually going to pay at the end of that term.
I think it's one thing that a lot of people don't necessarily talk about or understand either, the difference between rolled and retained, because even, you know, in my experience, knowing that actually the interest is rolled up at the back end, as you said, it just means that you're going to have so much more money on day one. Obviously you have to then pay that interest at the back end rather than when it's retained, as you say, which effectively means that, you know, your net day one loan is the loan minus all that interest for a 12 or 18 month period or whatever it is. And I think sometimes people don't, because they don't even ask that question, especially for new borrowers, they don't understand it or realise it until they've got much further down the line with the heads of terms and perhaps are even in the transaction.
Yeah, definitely. It does pop up on the last day of completion and be like, what does that mean versus retain? So yeah, we do get that quite a bit.
Yeah, what we do with our customers, we always provide them with three options. We provide them with a rolled option, a retained option, and a part and part. So we give them the options, explain what means what, so that they can make an informed decision on day one. And invariably, they are looking for the most money, and that's where the rolled comes in. And like I said before, there's not many lenders out there that do it. So it's encouraging that you've kept to that strategy, and hopefully it will continue going forward.
Definitely. And I think there was a bit of a shift probably at the beginning of the year, where a lot of bridges moved from fixed rate bridging to variable rate bridging. So, you know, we're on a variable tracker, which is tracked on a base rate. So if your rate goes up base goes up, your rate goes up, and vice versa if it goes down. So to have that kind of flexibility as well, especially where I'm probably moving into the next section, but as where rates are looking to go, we're hoping base will be coming down at some point. It did the last time round. So it kind of causes a saving anyways with your borrowers who are already on terms with us, so we pass on that saving. So if it goes down by 0.25, you're saving 0.25 over that time from when it went down. So that combined with roll.
That is interesting, the fixed and the variable aspect, because I remember when COVID was happening and the interest rates were starting to go up, the USP was we're on a fixed rate and it's not going to move. But now it's going the other way, and Goldman Sachs believe base rate's going to drop to 2.75 by the end of 2025. So being in a variable rate is maybe not a bad thing. And people's projects with you, if they're starting today, that's quite a big shift downwards if in 12 months. So yeah, it's something to look out for. And do you know what? None of my customers have asked me about fixed or variable on bridging. Not since the rates were going up.
Yeah.
Nobody's asked me. And
Is it because a lot of lenders are on variable now, or they're still fixed? Because I'm not sure in terms of the landscape of what the split is at the moment.
Yeah, I was going to ask the same question, because on a project that I've recently completed on, a number of the lenders I spoke to said that they were variable until the point at which you actually draw down, and that's it. Once you draw down, it's fixed to that level. Mm-hmm. But I'm interested here, Mark, what are you seeing in the market with other lenders?
Yeah, it's a mixture really. We have most of them are variable, I would say, but there are some that are still fixed. Some that are, I suppose, the ones that fixed when the rates were going up are still fixed as they're coming down. So there are, and some of your bigger competitors are still fixed. I think you've got an advantage being variable at the moment, but again, who knows? Rates can go up, they can go down. You have to weigh that up and do your own research. It's obviously very important.
And the thing is, we don't, a little bit of inside information here, but we don't actually have a floor. So if base rate did go to 0, we don't actually have a floor. You will be charged your margin and 0. So we are very much about, we are tracking that base rate. And if that base rate does go down, then, you will get that full, benefit of it.
And there aren't really any risks to you as a lender, though, because your margin is fixed. You always know which margin you're going to make.
Exactly.
Yeah, the wonders of how lenders make their money and what happens in the background, and that's what we're trying to do on this podcast. We're trying to allow people to have an insight in what's going on in the background and why things are variable, why things are fixed, why some lenders are doing rolled interest, why retain. Because to the average customer, the average property investor, there is no rhyme or reason for it. So we're trying to enlighten people, and then they're able to make more informed decisions about what they want to do. So it's great that you can come on here and tell us, why Octane are doing what they're doing and what makes them unique in the market. And I know, Ro, you probably know it more bridging lenders than I do, and Octane have been very good for you in the past.
Yeah, indeed. I'm sure you know a fair few more than I do, but no, but it has been good. Tell us a little bit about because you've had some new products. So I understand in the last sort of month or so, you've actually introduced a higher leverage product as well. Is that right? Can you tell us a little bit about that, Shrena, and the sort of the sort of investor profiles or projects that might be more applicable to?
Of course. So as how the market is shifting, we've kind of also shifted our appetite. So for a very long time, we were still sitting at our 70% product on our refurb. But as you can see, there's a little bit more confidence in the property market. We have shifted upwards where we're now lending up to 75% net on our refurb product. And that's for kind of, your property investors who have got experience, they've done projects 2 or 3 times over, etc. It's light refurby stuff, so you're not going to have kind of your PD schemes on that or your heavy refurbs. It's going to be more of your kind of no structural changes, light works, maybe doing 4 or 5 bed HMO kind of thing, up to 6 possibly. So that's what our 75% product is used for, and it works very well for your loft conversions, your side extensions, your rear extensions, your auction kind of flips, as well as your kind of, let me just modernize the, inside of this house, maybe sell it on, etc. We also have a self-funded product as well now too, where we will allow you to self-fund the work. So typically before, Octane was very much about, we want to control kind of the development, the works being done on a property. We're now saying if you're an experienced developer, done 2 or 3 similar projects, up to 250k of works, if that's what the project is costing, we will allow you to fund on our self-funding refurb product. And how that works is we'll still use your GDV to lend against on the back end. We will still put in the cost of works in there, but we just won't charge you an arrangement fee for those works. So what will happen is that allows us to use 75% day one, roll it to your GDV to give you the best maximized net day one. And then what happens is if you don't want to use that money, that's fine. If you do want to use that money at any point, even £1 of that facility, you will then get charged that arrangement fee for that, let's say 250k of works. So some people might use half of it, some people might not use any of it. Some people might just use it at the end and say, look, I've actually finished this project all by myself and I now want to just take some cash out and put it into the next project. And we're happy to also do that. So it's kind of like a bit of a revolving credit kind of facility for those who don't need it, but then they've got, funds on demand if they see another purchase, let's say, and they want to act quickly on it. So that's kind of a bit of a niche product that we've just launched in the last couple of months, and that's been going down very well. But it does capture a small kind of portion of, those developers, because sometimes the works is more than 250. Sometimes, and also the minimum property has to be 250k as well for purchase. So sometimes the smaller ones fall out of bed on that. So those are the two kind of, products that we have launched. And actually there's a third one. So we've also done a 75% dev exit as well. So for like when your development has come to an end, you now want to sell it. So you might have built out, 4 houses, 10 flats, etc. And you want to put them on the market. We will now go 75% gross on those kind of assets for you as well.
I was going to ask you about your development exit. Were you because you used to do like a term product as well, right? Where you would effectively a more flexible mortgage. Are they still around, or is that still kind of in the realms of the development exit product?
So we stopped our buy-to-let products in 2022. So we used to have 2, 3, 5-year products. They were very flexible, kind of short-term. It was capturing not the long-term market, not the short-term market, but in between basically, because it would be for 2 to 3 years. We stopped that in 2022 when rates started to go up. And to be fair, I don't think we'll come back in those kind of products. And that's just because as a bridger, you're making your money back and your return back on a 12-month to 18-month bridge rather than waiting for a 2 or 5 year buy-to-let to repay back, in terms of profit. So I don't think that's something we're going to go back into. But our developer exit, we can go up to 24 months. So if you do want something up to 24 months, we can do that on a bridge. If it's exit sale, we can't service it because obviously you're selling it, you're not going to have tenants in it. But if you did have kind of, developer exits where you're looking to get tenants in and you're trying to get it filled before you go onto a term product, then we can kind of structure it in a way where we can part service the facility too, because if you've got tenants already on completion, we can use that portion of rent. So the key to us is we will allow servicing, but it's got to be serviced from the security that we're lending on. We don't use outside income.
Got it. Sorry, Mark.
With your development exit, what what's the earliest stage a building can be at to go onto that product?
Sure. So we can come in when you're in your last 10% build cost. So it's always done on the build cost. So if you've got, 100k build cost, you've got to be in your last 10k, for example, for us to put it onto there. So we don't need it to be a PC, we don't need it to be a practical completion. We can come in and we can also fund the works that you require to kind of get you to the end as well. So we're okay with that. It needs to be wind and water tight at least, and the last 10% as well.
Are you using asset managers as well to manage and monitor the costs, or is it external consultants? How do you typically monitor the build project costs?
Yep, both on our developer exits, part complete, along with our refurbs, heavy refurbs. It's always internal asset managers. So we use them, which are more cost effective. So instead of yourself or your clients paying $2,000-3,000 for a quantity surveyor to come out, you're paying fraction of the price. You're paying £295 per visit from an asset manager, which also helps in terms of profitability, because if every time you're drawing down you're spending $2,000-3,000, it cuts into your profit in terms of on the back end. So we try and be a bit mindful there as well.
That's good.
It really is, and there are so many different strings to the Octane bow now. You've got a lot of different products, and you've obviously got a very experienced team, and you've got Lee Warren as well, which makes a massive difference to any team. So it is, it's great to see where and how Octane have changed. The team has evolved a lot since I remember when I first started in broking, and you're at the forefront of everything that in the bridging market now. So. One question I've got for you, and this is a bit of a loaded question. How do you see the challenger banks and their bridging in comparison to your bridging? Do you see them as competition, or are they a little bit sluggish in comparison to you guys?
I suppose what I would say is, as I've been here coming to 5 years, I have seen the change in Octane. So where I started in 2020 and the type of appetite we had and the pricing we were on versus now to where we are appetite-wise and pricing, we are very much priced with the challenger banks, or probably even cheaper than some of the challenger banks. So that kind of shows that we've got good funding lines that can allow us to lend money at a good margin. But in terms of the challenger banks, I think the difference between us is we can still be quick versus a challenger bank. So a challenger bank will take typically a little bit longer than what we would. We can complete, I've had 7-day completions if I've got a legal pack in plus a valuation retype. So, it can happen. 2 to 3 weeks is kind of typical with a valuation, a full valuation. So we're still quick in terms of that. And also we a little bit more commercial, so it's not a tick box exercise. So if it doesn't fit these 4 boxes, then unfortunately you can't do bridging with us. We will take views on stuff like adverse company structures. I'm doing one at the moment where there's 7 companies, so you're lending to one limited company, behind it is another limited company, behind that is another 4 company, and it gets a little bit more complex, and some challengers will probably be like, it's just too much in terms of structure wise that we can't assist on. So, and we're happy to do that kind of stuff. Also, some challengers might not like more than 2 or 3 investors in the background as the deposit. Well, we can be a little bit more flexible on that because we kind of understand a lot of investors are using other people's monies now. That's kind of the strategy. You don't want to put your cash in, use someone else's cash. So we understand that. So we are probably less rigid than the challengers, I would say, to why we get quite a lot of the share of the market in terms of business. I will say with first-time buyers, first-time landlords, we're probably, not as, as keen on leverage to those first-time buyers, first-time landlords. And that's just because we're kind of choosing what we want to do. We want to lend to your experienced borrowers, your experienced investors. So you will get your lenders and your challengers who will be happy to do your 75-80% on a first-time person doing a first project. But we're kind of not in that space. Like, we know what works for us. We know what asset classes we like. Like, we like C3 assets. We like C4 assets. So C3 being your normal residential kind of assets, your C4s being your HMOs, your small HMOs, etc. We like your sui generis kind of bigger ones, 8 to 10 to 12. We've done 13, 16 beds as well. So we will do your bigger HMOs. But we know that, we're not big on, we don't do stuff like hotels. We wouldn't do care homes. We wouldn't do, C2 assets kind of thing, which is like a bit of care home supported living aspect. So if every lender has their niche, and that we know what our niche is, and we don't want to kind of, take anyone up the wrong garden path in terms of trying to make it fit into our box, when we rather just say, look, this is what we like, and this is where we can excel in, basically.
Very sensible.
One thing I've noticed you don't do that other lenders tend to do is hide behind their funders as well, by saying, oh, our funding line won't allow us to do that, or our funders won't, we can't change anything because our funders won't allow us to do it. And we're getting that more and more now, where there's a request to go in, say, I don't know, something silly like somebody's got a mobile phone bill they've not paid or something, and there's a £10 default on the account, and they're like, oh, our funders won't allow us to do that because there's one default. And you guys do seem more flexible than some of the others in the market. So
I would say we do quite a lot of the initial kind of underwriting at the beginning. So even at AIP stage, when you're getting your dip, we are actually putting it in front of a credit manager who's actually having a look at the asset, having a look at, planning, etc. So we're kind of doing a lot of due diligence up front in terms of when we give you that AIP, we want it to look the same as what we've offered you. The only things that's going to change those terms is, one, the valuation, if it down values, up values, whatever else it does, and if there's something you just haven't disclosed, because at that time we aren't doing credit searches. So let's say we do a credit search and you've got 10 liquidations in the background that you forgot to advise us of, then obviously the deal is going to change. But other than that, if you say to me, and this is a thing, like good brokers do this, they will find out all that information up front. Like, if you've got a missed payment, just tell me, or if you've got a default, just tell me, and we can work with that. So that's kind of the key. It's rather, let's not get nasty surprises in the back end, let's get them all kind of sorted out at the front end.
Yeah,
that's such invaluable advice.
Agree with that. And there are a lot of things that do pop up along the way, we see, and we encourage our customers to do a credit report before they come to us. But a lot of the time, well, not a lot of the time, some of the time, customers are like, oh, do I have to provide this information now? Can't I provide it a little bit further along? And it's like, well, no, because we need to understand what your situation is so we can put you in the right place, because there's no point you being, terrible credit and all that sort of stuff, and then us placing you with somebody who doesn't look at that type of deal. But one question I have got for you, and it's something that I've come across a few times, is regarding customers who use more than one broker. So what they'll do is they'll have a project, they'll go to maybe 2, 3, maybe even 4 brokers and say, can you go out and find me the best deal? And invariably a broker will use, or they'll invariably go to similar places. So your underwriter will get the deal in, say, 3 times. Does that, do you think, have a negative impact on the customer?
That's a great question, actually, because this is something that's come up a few times. I've not done this to Mark, by the way, but
you always do. Rose, stop doing it. Stop talking to them. There's only one broker in this area.
Exactly. But no, it's a great question. I'm really interested to hear Shrena's view on this.
Yeah, to be honest, when they're purchases, for example, we will see the same purchase probably 3, 4, maybe 5 times in a space of a week or 2. And that's fine, because we understand, borrowers are going to go to the market, and if we're doing our job right, we should be getting a pick of all 5 of those, purchases, right? Because we are a lender of choice. So that's not an issue. I'll tell you when it turns into a negative is when you have that same deal that comes to you over a space of a year at different points in that year from different brokers. Because let's say Marc showed it to me in January, and then another broker shows it to me in March, and then again in November, and then again in December, and nothing's changed. It's like, well, there's an issue now because you've had it for 12 months, it's still not been placed, and it's still at the same point it was in January to December. So that's the only time where credit might turn around and say, like, we don't want to entertain this deal in, because we've seen it 4 or 5 times, all from different brokers, and it just seems to be an issue. But when it's purchases, and it's like, you'll usually only get it in the first couple of weeks, because that's when they're going to go out to market. And then we know that we've got 3 or 4 brokers all competing for this, client. And to be fair, it might not even be the same client. It could be 5 different clients, because they're all putting in an offer or a bid to that property. So yeah, that doesn't cause any negative or adverse, mindset to us in terms of lending.
For me, it doesn't sit right, because what I expect a experienced developer to have is the power team around them that they use on a consistent basis, who they're comfortable with, who they've been through projects with before. So they should have a broker, they should have an accountant, a solicitor, they probably should even have a lender that they prefer working with. When you see experienced developers or refurbers going out to more than one broker, maybe a couple of brokers, but not like 3 or 4, then that always it spells trouble for me. It really isn't good, because I think, one, they're trying to really cut costs as much as possible, so our fee gets paid at the end, and it's those types of customers we find are the ones that are more reluctant to pay fees at the end. There is a direct correlation that we've seen.
And I think the most amount of, just before I forget my thought process, I think the most time you do see those experienced developers, investors going to other brokers is, you hit the nail on the head. It is because they're thinking, okay, I've been doing this a long time now. I can probably get a cheaper deal. I can probably get a better cost saving. And that's literally it, because we do see stuff where we're like, but they've used this broker for 8 years. Why did they go and find broker B all of a sudden? So it's either a communication issue with the broker, something's happened, they fell out, or they're not happy with something. Is usually 9 out of 10 times the reason why we see a deal from a different broker after it's been in such a long relationship with a prior broker.
Yeah. And go on, right?
No, I was this might, if I may, just what defines so in your eyes as the lender, Shrena, what defines a good broker? Because it's good for our listeners to understand what actually makes a good broker, versus an application which is handled by a not so good broker in your eyes. So what should they be looking out for?
Do you know what it is? I can't say there's a good or a bad broker. Every broker has a different style. So you've got your hands-on brokers who knows everything about the deal, can reel you off everything about the borrower, their experience, what have they done, because they've been close to that borrower and know everything about them. Then you've got the brokers that have no idea, and they literally give you a telephone number, a name, and a few bullet points. So it's kind of, as a lender, we can tackle both, because we're happy to speak to the borrower direct just to get the information. Like, we'll never cut a broker out, but we can speak to them directly. So we don't mind, but it obviously helps when it's packaged well. There's more information up front that we can kind of make our assessment early, kind of thing. And also there's brokers who, and I have to be honest, that do start dabbling into the bridging world. So they might be doing buy-to-let or regulated lending for a very long time, but have decided they want to now, shift focus and expand, and they will start doing bridging. And there's nothing wrong with going into the market, but a lot of brokers may not understand what non-regulated bridging is. So therefore you get a little bit of a confusion at times about certain kind of, terminology, certain kind of, products that can be used. And it doesn't mean that's a bad broker. It just means it's a harder case to kind of unravel and figure out if it's something we can do, basically. So yeah, it's just different spectrums, I suppose, of the level of experience.
Yeah.
So, Ro, what would you do? Say if you were a new customer, new property investor, without any grey hairs or anything like that, and you were starting out, how would you go about looking to get lending? What would be your first
Yeah, I think about my early days. I went to a lot of networking events, and when you go to networking events, you meet a lot of brokers naturally. I mean, you have brokers that, as a broker I used for a long time on a lot of my residential stuff, my refinances on the home and things like that, and that was kind of my start point. But as you go to these events, you start learning about this space and investing more professionally in the different types of products and the different types of projects that you might want to expose yourself to, and you realise you need someone with a bit more specialist knowledge who has access to the right sorts of lenders. But the point I'm making is because you meet so many, you don't always know who is the right person to work with, because they all want your business at the end of the day. And even if you have got a deal which you're looking at and you say, actually, I've got a broker who's looking at this moment, say, well, give us a go, send me the details, I'll put a few feelers out anonymously as well. So that is something that does happen, and I think that's something that, certainly for starters, or people who are new, they might not necessarily have the experience or knowledge to know who to go with, and that might actually contribute to this whole situation where you have got the same deal that's actually being possibly presented by different brokers. So I guess to answer your question, what I look for now is for people who demonstrate a deep understanding of the type of project, the type of product that I'm after, and have access to good lenders, and actually will fight your corner to present it well. But that kind of comes with experience, because you don't really know how good a broker is or how good that experience is going to be with that lender until you've actually done it at least once. So I think especially for those out there who are starting out, it is a bit of trial and error, I have to say.
What we find is actually we talk to people in networking events, or people see us post on one of the social media channels, and then they stalk us for a long time. We have people looking at everything we're putting out, and I had somebody who said, there's actually two people recently said, I've been watching you for about a year now on social media, and I thought I'll give you a call now because I feel comfortable, and what you've been talking about has been relevant. And I think our marketing strategy is education. It is trying to help people, and this podcast is part of that. But we put out blogs every week about how to finance HMOs, how to, like this week's one's going to be about angel investors, and there's lots of different things we do, and we then find people gain trust in us, and then they come to us and then give us the opportunity. But yeah, there are a lot of brokers out there, like you said, at networking events who you meet, and I'm thinking, please, just for your own sake, don't talk to them. Just go anywhere, but just don't talk to them. It's just not great for you as a customer. So yeah, it is interesting to hear your viewpoint on that.
I think actually the point you've made there, Mark, about the people taking their time to get to know you, even though from a distance, and you don't know who they are until they contact you, but there's a lot to be said for that, and that's actually why I very much enjoy working with Mark on these. I'm not part of Wharf Financial, but actually I can see there's a huge amount of content and value that's put out there, and it's no different to when you're trying to attract, and say for me as a developer, it's the same process with attracting investors as well, because you have to be consistent, put a message out there, people need to know who you are, and they will watch and observe before they make a decision. And arguably it's the same with vendors who are selling properties or selling deals. They'll watch you and they'll see if they're ready to transact with you, especially if you are quite well known and you're putting a lot of stuff out there in social media, or if you're somebody who's simply writing to them a lot and sending a lot of letters about a site that they have. That consistency does pay off in the end, and there's a lot to be said for that, for sure. Very good.
Yeah, Shrena, just a question and on something that Octane have done differently historically. You don't provide a product guide. Yours is all bespoke, and I know when Marc Posniak was there, he was very proud of that. So I presume that I don't look, because I obviously know your products pretty well just off so I don't have to look at the product guide. I presume you still don't have a product guide?
So we don't have a product guide per se, so it's not like a rate card, but there is a one-pager product guide that will tell you that we do refurb, straight bridging, developer exit, and it will give you kind of the leverage will go to and the rate we start from, so like the margin, but it won't tell you exactly what your rate will be on a specific deal, because what we're trying to do is we'll price all deals differently. Like, it depends on your experience, it depends on your leverage, it depends on the type of project, it depends on, you know, where it is, kind of thing. So we are very bespoke, and we will try and, you know, get that pricing right for the right client. So we don't want to be pinholed into a box where it's like, okay, that's your rate, and that's where it sits. So yeah, no rate card, but we have some sort of kind of, you know, product guide to let you know what we can do and what limitations we have.
Good. Well, Ro, any more questions for Shrena?
Yeah, I mean, just one quick one. What are you seeing any changes in the market right now in terms of the types of the types of borrowers or the types of projects that they're looking for funding for? Have you seen any early signs of changes in the last 3 to 4 months, and where do you see the biggest opportunities right now?
I think we're seeing a bit of the last couple of months we've seen a bit of a slowdown, and I don't know if that's just because people are waiting for the budget just to find out what's going to happen, if it's going to be, you know, pro or con against, you know, investors, etc. So we have seen a bit of a slowdown, but then you have got your, you know, your investors who will carry on regardless. It doesn't matter what changes happens, we're just going to carry on. And we are seeing, you know, more of the shift still in terms of like changing, going down the commercial route rather than just the resi route. So I'm getting, you know, a lot of, I want to buy an office space and I want to buy a, you know, an industrial unit. And it's not to change it to resi or anything. It's just, I want to, you know, diversify, and I want to add some commercial into the mix, kind of thing. So yeah, so we're seeing a lot of that. We're still seeing a lot of auction happening in terms of, you know, multiple people on the same property. So we will see, you know, if it's a good property, we're going to see quite a lot of people go for it, which again then causes, you know, is that property being sold for the correct price? Because if you've got 5 people that really want it, how much are they going to carry on bidding until it's actually bidded out of the market value and you're actually overpaying for it? So we are seeing a lot of projects coming to us where there's no profit in it, so they want to sell it at the end, but what they've bought it for after the works, there's not sufficient profit in there. And then when you kind of challenge, so what we do different to a lot of lenders, and that's just because we don't want to waste our time, your time, brokers' time, borrowers' time, is if we feel there's not sufficient profit. So let's say example 15% profit on a deal where you're going to not refinance the sell, we will ask the question, why would you buy something where you're making 8% profit? If your costs overrun even by a couple of months, that 8% erodes down to 5%. And after all that, is it worth doing? So we're kind of doing a little bit of a challenging, but I feel like a lot of it's more with the more first-time buyers, first-time landlords that are kind of, you know, trying to get on that property ladder, trying to buy this first project, think they can do it for cheap, get out quickly and, you know, sell it. And we're seeing a big uptick on those. So I'm not seeing as many experienced people coming across my desk at the moment, and I think that's because the experienced people are probably holding off, and then I've got a lot of the first time kind of market that they may have buy to let portfolios, but they now want to go down the flip route. So they're now thinking, okay, what can I buy? What can I flip quickly? But the numbers just don't stack up.
Yeah, no, you know, I'm in that position. I have a buy to let portfolio, but I know anything I buy as a buy to let, I'd probably get a better yield putting the money in the bank than doing a property buy to let. So it's probably not worth me doing. So I have to now look to something a little bit more adventurous, i.e. a flip, refurb, whatever it may be. So you do need to think, and when these new people, not new investors, but new refurbers are coming into the market, they are going to be testing the water to see what they can push. And I think we'll see more of that. But I was on a panel at Brendan Quinn's Central London Property Network a couple of nights ago, and the other people who were on the panel were all talking about you've got to make sure you've got the right location, you've got the right property, you've got to make sure you add value. But one thing that I mentioned that nobody else was talking about was you've got to get the right timing, and you've got to be thinking about where the market is when you're going to do things, and what your situation is. is it the right time for you? So
Yeah.
I think we are going to see more, but I think a few people are trying to force it a little bit too much at the moment. So it'd be interesting to see, say, in 12 months, if some of your competitors have funded this, where they sit, especially on the HMO stuff, where they've done a 3-bed terrace house to a 6-bed HMO or a 5-bed HMO conversion, and then the investment valuation doesn't come through at the end. I think that's where we're going to see a few issues, I predict, next summer.
There definitely will be, because even now when we're doing HMOs, we have certain methodologies depending on the number of bedrooms and depending on if it's in an Article 4 directive area. And a lot of competitors will do 4, 5, 6 bedrooms outside of Article 4 on an investment yield basis as an exit, which is amazing and great for, you know, your kind of exit route to get some cash out. But it's long-term kind of sustainability in terms of, you know, that lender might do it, but then when you go for your refi the next time around, where's that valuation going to come in at? So we are seeing a lot of that. And, you know, if you're not experienced in that market, your GDVs are going to be much higher than you anticipate, you know, than they're going to come in at, basically. And then that could be the be all or break all of that deal, because if you haven't got that extra 20k to put in now day one because your GDV came down by 5 or 10%, then you've now put a 10% deposit down on a property that you can't complete. So, you know, there's a lot of kind of, as you said, timing, risk factors. How you know, how comfortable are you if the numbers don't stack up? Have you got a reserve that can, you know, get you out and get you to the end of that completion? So we are seeing a lot of that. And just to kind of just summarize a bit in terms of what else we're seeing. So we are seeing a lot of people taking advantage of the PD kind of schemes and being able to like PD offices into resi. There's also, you know, new legislations that have come in where you can, you know, if you've got a commercial with commercial uppers, let's say 3 floors, you can do floor by floor under PD. So you don't have to get the full planning for all 3 floors. You can say, I'm just going to PD the first floor, and then you get that floor PD'd into resi before you move on to the second floor. So people are becoming more creative. They're becoming a little bit more, you know, adverse into how can I, you know, do certain projects where I don't have to wait the longer time frames to get full planning. What can I do in that 56 days prior approval, you know, route, or under the PD kind of scheme? So, and I think that's where a lot of the investors are probably making more money, I suppose, because they're not having to worry about, if planning doesn't come through, what am I now going to do with a commercial asset that I can't do anything else apart from use it as a commercial asset? So yeah, it's all about creativity at the moment.
Great advice.
Good. Right. Well, we'll bring it to an end there. Thank you very much, Shrena. As always, great to see you. And
thank you.
Thank you for your time. So we'll be doing this again next week at around 1 o'clock on, what day is it today? Tuesday. Is it Tuesday? It is Tuesday.
Yeah, indeed.
Yeah, 1 o'clock on Tuesday next week. Hopefully everybody can tune in. Also, our YouTube channel you can subscribe to. There is a Show Me the Money YouTube channel, so please feel free to do that. And that's it from me. Thank you very much, and I will see you all soon.
Thank you, guys.
Thanks so much, Shrena. Great to see you all.
Bye.
Cheers.
Bye.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.